we are very fortunate to have, a great paper on the efficiency of FDIC-identified community banks. That is the community banks identified by the U.S. Federal Deposit Insurance Corporation. It's a very interesting paper, and also with very strong co-authorship involving 5 leading scholars. The presenter today will be Dr. Athina Petropoulou, whom you've met previously, is a very active member of the Center for Global Finance here at SOAS University of London, but also involves the other co-authors, Dr. Vasileios Pappas at the University of Kent, who is here and who presented a paper recently to us, Professor Stephen Ongena at the University of Zurich, Professor Dimitrios Gounopoulos at the University of Bath, and Dr. Richard Fairchild also at the University of Bath. This is the 5 great minds coming together to work on this piece of research that they're going to share with us. But it is always befitting, as the tradition of the Center for Global Finance, to introduce the speaker in detail, just in case you have not participated in the previous seminar. Dr. Athina Petropoulou is a postdoctoral research fellow here in the Center for Global Finance at SOAS University of London. She joined SGF in 2020 under the AXA Chair in Global Finance. And before she joined us, she held positions at the University of Bath. Her core research interests lie in the areas of banking, where she investigates issues like credit risk, liquidity risk, bank efficiency, and bank competition, involving alternative banking models. Could be community banks, could be commercial banks, could be long-term financing banks, and so forth, like development banks. She also has other research interests in finance and financial econometrics, and has been involved in a number of research projects here at SOAS University of London, previously at the University of Bath, and also currently at the University of Kent. And her research has been presented at leading international academic conferences all over the world, IFABS, Infinity, and also has published in the Journal of International Financial Markets Institutions and Money. She is working full blast on quite a number of interesting research projects as part of the Center for Global Finance, but also in collaboration with the co-authors who will be presented here. So it's a great pleasure to welcome. But before I invite Athina, let me a couple of housekeeping to say, please mute your microphone if you are not using it. And secondly, please post your comments, feedback to the chat. But of course, if you feel very strongly you want to intervene, we're happy to allow you say something. Just raise your hand and I shall ask you to intervene. This work is research in progress, which means any observations you have, any feedback is very much welcome and very much appreciated. So, Athina, you have the floor. Please go ahead and present your joint paper with your colleagues. Thank you.
Thank you, Victor, for your kind introduction. Let me first share my presentation. Yeah. So, hello everyone, it's nice to see you again. So, as Victor mentioned, the paper that I will present to you today looks at the efficiency of FDIC-identified community banks. And it is a joint work with my co-authors, Vasileios Pappas from the University of Kent, Stephen Ongena from the University of Zurich, Dimitrios Gounopoulos and Richard Fairchild, both from the University of Bath. And here you can also find the link to the SSRN paper for anyone who might be interested in looking at the paper in more details. To give you an overview of my presentation today, so in the introduction part, I'm gonna be talking about the community banks business model, the geography of community banks, the research aims and the contributions of this study. Then in the second part of my presentation, I will be looking specifically at the community bank definition. And here we're also conducting an empirical assessment of the new FDIC definition of community banks. The third part of my presentation includes the efficiency of performance where we will be comparing community banks to their non-community banks counterpart. The fourth part of my presentation looks into the determinants of efficiency. And finally, I will be mentioning the robustness test that we have run so far and some concluding remarks. Okay, so since the 1980s, there has been a lot of consolidation in the US financial sector, which takes the form of bank failures, mergers and acquisition, and also with the freeing of the interstate branching. Now, these structural changes have actually reduced the community bank sector by 50%. During the global financial crisis of 2008, more than 500 US banks failed or received financial support, and most of them were actually community banks. Despite these structural changes that have decreased the number of community banks, we see that this type of banks still make up for 94% of the total banking organizations and are the only banking option in some underbanked areas of the country. For example, in 2018, in states such as Alaska, North Dakota, Vermont, and New Hampshire, community banks accounted for all of the banking organizations at these states. So these states were served exclusively by community banks. This shows the important role that community banks play for the US economy, which was also evident during COVID-19. Because community banks have been crucial to the channeling of economic support to firms that were affected by the pandemic, which was done via the Paycheck Protection Program. Also, community banks are very local in the way that they do business. So almost half of them operate under only one office, and close to 90% of them hold branches in just one state. Moving on to the geography of community banks. So the maps here depict the percentage of community banks as of 1984 and 2018. With the darker orange color, where the darker orange color represents a higher percentage of community banks, whereas the lighter sort of yellow color and blue color represents a lower percentage of community banks. In 2018, we see that community banks are particularly concentrated in the upper Midwest and Northeast corridor of the country. And they are prevalent in both metropolitan and non-metropolitan areas. And actually, many non-metropolitan areas tend to rely much more heavily, if not exclusively, on community banks. Now, in the next set of maps, we present the percentage of community banks, but now in terms of asset size, again, as of 1984 and 2018. And we can see that in states like, for example, in Nevada, Utah, and South Dakota, the percentage of assets held by community banks has dropped dramatically. But still, in other states, such as Alaska, Idaho, and North Dakota, and Maine, community banks are the only banking option. So 100% of the banking assets are actually held by community banks. But what does it mean to be a community bank? So community banks are perhaps most known for the level of personal service that they offer to their customers. So they are assumed to be relationship bankers rather than transactional bankers. They are the basic proponent of the relationship banking approach. The fact that these banks are small in size and they conduct business very locally basically helps them to develop personal relationship with their customers. So community banks have an intimate knowledge of their local community, and this gives them detailed information on aspects of their customers, like, for example, their managerial skills or reputation and things like that. And because of this expertise, they tend to base credit decisions on the local knowledge that they have and on non-standard data obtained through long-term relationships with their customers. So they base their credit decisions on soft rather than hard information. They are less likely than non-community banks to rely on model-based underwriting that is often used by non-community banks. Because the larger that the institution gets, the more difficult it is for it to manage a relationship at a personal level. So non-community banks tend to rely much more on hard information, which can be processed within computer systems. Community banks are close to the real economy, and they engage into traditional deposit-taking and loan-making activities. So they obtain most of their deposits locally, and they make many of their loans to local businesses. They also abstain from complex financial derivative structures and from other exotic investments. Now, the relationship approach that this bank type is using is particularly important for startup and SMEs, because this type of businesses are often unable to satisfy the requirements of a more structured approach to underwriting that larger banks use. So the relationship banking approach that is used by community bank is often the only avenue these businesses have to obtain credit or to access other financial services. Now, a few things on the regulatory framework for this bank type. So, in recognizing the importance that this bank play for the US economy, the regulators have introduced targeted measures for this bank type. Following the global financial crisis, there have been actually 157 federal rules and programs introduced specifically targeting community banks. For example, the community bank leverage ratio intends to reduce the regulatory burden of risk-based capital adequacy ratios on community banks. And close to 40% of all eligible banks applied for this framework at the first instance. The amount of the programs show the commitment of the policymakers to cater for this specific banking business model. Eligible for this kind of differential regulatory treatment are FDIC-identified community banks. But how does the FDIC actually identify this type of banks? While there has been a rough consensus on the attributes that describe a community bank, actually defining one proves to be quite difficult in practice. Previous research in community banks has defined them by using a single size criterion, which is basically their size. So they are defining them in terms of their total assets. However, in 2012, the FDIC proposed a new research definition for community banks that introduces geographical and business model criteria. And this has been the first time that business model characteristics are used together with a size criteria to define this bank group. Now, due to increased regulatory interest in the new community banking definition, in this paper, we place the FDIC definition itself and the community banks in general under the microscope. And from a definitional comparison perspective, we evaluate the financial profile of FDIC-identified community banks against a range of alternative definitions that were solely capturing size. The Chiorazzo et al. 2018 paper suggests that community banks are actually more likely to survive. However, the authors do not address the role that efficiency plays in the ongoing survival of these banks. Yet, efficiency in the resource allocation is critical for community banks' survival and performance. So for this reason, we extend on this study and evaluate the efficiency performance of FDIC-identified community banks against their non-community counterparts. We then we focus on cost efficiency, and we have actually estimated quite a few models for cost efficiency from a very simple model, moving on to a more complex one. And we also employ the model introduced by Kumbhakar et al. At the 2014 paper, which actually, in this model, the authors separate a persistent component of efficiency and a residual component of inefficiency. Now, this decomposition is critical for our setup because it allows us to separate the efficiency differential into a component that is reflective of market structure, regulatory, and business environment characteristics in general, and another component that is related to managerial performance and business strategy. So persistent efficiency, or long-run efficiency, as it is sometimes called, is relevant for the regulators and policymakers because it can be used to assess the efficiency of the banking models within certain regions of interest. And residual or short-run efficiency is of primary concern at bank level because it can be affected by short-term adjusted or targeted strategic choices within the bank itself. And we also examine the drivers behind persistent and residual efficiency performance. Now, with this study, we seek to make at least 4 contributions. So first, it is the first study that compares FDIC community bank definition against a range of alternative definitions that have been commonly used in the banking literature. Secondly, we examine the financial profile of FDIC-identified community banks against previously misclassified banks, and we actually find that disregarding business model characteristics leads to a significantly different outcomes when it comes to the financial profiles of the bank included. The third, in terms of methodology, the efficiency decomposition is novel for the US community banking setting and is crucial for disentangling efficiency from factors that are beyond the bank's control, from factors that can be directly controlled within the bank. And fourth, we uncover the drivers behind the persistent and residual efficiency components performance. Now, as I mentioned before, previous research on community banks has defined this bank group by using a single criterion, which was their asset size. However, only defining community banks on the basis of their size has several drawbacks. And for this reason, the FDIC in 2012 came up with this new research definition. And the table here shows how the FDIC arrives at this new definition. So this new definition basically excludes organizations with 50% or more of their assets within a specialty organization, such as credit card specialists, consumer loan banks, industrial loan companies, trust companies, and bankers' banks. It also excludes organizations where foreign assets account for more than 10% of their total assets, and excludes organizations that have no loans or no core deposits. At the same time, this new definition establishes standard requirements for lending and deposit gatherings. So it includes in the community bank universe banks that have a ratio of loans to assets that is above 33%, and banks that have a ratio of core deposits to assets that is above 50%. It also sets limits on the geographic scope of operations, such as the maximum number of offices that the bank can hold, or maximum number of states where the bank can do business. And finally, this definition also establishes an asset limit. However, this asset limit is adjusted upwards over time to account for inflation, for economic growth, and for the size of the banking industry in general. Now we compare the FDIC community bank definition against a conventional asset size definition. These are definitions that solely rely on size to define community bank. So the Fenken-Zhang definition classifies as community banks those with below 1 billion in assets. this is a threshold that it's not adjusted over time, and no business model criteria have been imposed. The Tiorazo et al. Definition classifies as community banks those that have between 500 million and 2 billion in total assets. Again, this threshold is not adjusted over time, and no business model criteria have been included. And finally, the Bonilla et al. Definition classifies as community banks those with less than 10 billion in total assets, again with no adjustment over time and no business model criteria. After we impose these definitions in our sample, we end up with around 20,000 community banks under the Feng and Zhang definition, around 3,500 banks, community banks, under the Tiorazo et al. Definition, 20,000 and a half under the Bonilla et al., and close to 18,000 under the FDIC definition. Now, to evaluate the FDIC definition against these alternatives, we conduct a joint classification analysis. Dual definitions give rise to marginal cases under 3 distinct groups. So we have an intersection group, an exclusion group, and an inclusion group. And the bottom graph shows a visual representation of how banks fall under different groups. So basically, the intersection group features FDIC-identified community banks that are jointly identified as community banks under each of the other 3 definitions. A community bank by exclusion, which is bank A in the graph, is one that an asset size definition classifies as community bank. However, the FDIC definition excludes it from the community bank universe, either because it is above the asset threshold or because it violates certain business orientation screenings. And finally, a community bank by inclusion, which is bank C in the graph, is the opposite. So that is an FDIC-identified community bank, which, however, is a non-community bank under each of the other 3 asset size definitions. In the next part, we move on to an empirical assessment of these misclassified banks. And we start with the banks that have been included by the FDIC as community banks. So the graph shows the relative percentage of included community banks from the FDIC definition by state as of 2019. The reference group is community banks identified under both the FDIC and the Feng and Zhang definition, so basically the intersection group, and it is compared against FDIC-included community banks. So banks that are classified as community banks under the FDIC, but not classified under the Feng and Zhang definition. The top graph shows the percentage of FDIC-included community banks relative to the reference group. And the bottom graph shows the average size differential between FDIC-included community banks and the reference group. This is the yellow bars. And the blue narrow bars shows the average size differential between FDIC-included community bank and the total state level banking system assets. So we can see here that across all states, FDIC definition includes around 24% of community banks on average. Now, these included banks account for almost 30% of the total banking assets. This appears to be particularly important for some states. We can see, for example, that in Maine, 85% of banks are being included, and these banks actually account for 82% of the total banking assets in the state. In Rhode Island, the included banks by the FDIC definition represents 92 of the total banking assets in these states. So we can see here that the new FDIC definition actually brings into banks that account for quite a large number of the total banking assets in certain states. We also look at those banks that have been excluded by the FDIC definition. However, they were included by asset size definitions. Here the graph shows the relative importance of the excluded community banks by the FDIC, again by state, as of 2019. And the reference group is community banks identified under both the FDIC and the Feng and Zhang definition. And these banks are compared against the FDIC excluded community banks. So same as before, the top graph shows the percentage of FDIC excluded community banks relative to the reference group. And the bottom graph shows the average size differential between the FDIC excluded community banks and the reference group in the green-white bars. And also the bottom graph shows in the narrow red bars the average size differential between FDIC excluded community banks and the total state level banking system assets. Here we can see that across all states, the FDIC definition excludes around 5% of community banks on average. These excluded banks manage around 8.5% of the community banking total assets at state level. And in the state of Utah, the FDIC community bank exclusion criteria remove actually 40% of community banks, while these account for almost 97% of the community banking total assets in this state. In the next part of our analysis, we examine the financial profile of the different community bank groups. So this graph shows key financial ratios for the four groups. So for the intersection group, the exclusion, inclusion, and the non-community bank group. And when compared to non-community banks, the intersection group, so community banks that are identified as such by both FDIC definition and asset size definitions, exhibit lower credit and liquidity risk, higher deposit ratio, lower income from non-interest generating assets, lower efficiency as it is measured by the ratio of cost to income, lower profitability and better capitalization. The FDIC exclusion criteria remove banks that have higher credit and liquidity risk, lower efficiency, and high profitability. And the FDIC inclusion criteria bring into the picture banks that have low credit and liquidity risk, high efficiency and high loan-to-asset ratio. In the next part of our analysis, we turn to the cost efficiency. And in the literature, cost efficiency can be measured using either financial ratio analysis or frontier estimation methods. The drawback with financial ratio analysis is the fact that it does not take into consideration the input prices and the output mix. Within frontier estimation methods, a bank's observed production point is compared with a production frontier that denotes the best practice. And here, data development analysis and stochastic frontier analysis are the two principal methods. In this paper, we focus on stochastic frontier analysis as it is better suited to deal with panel data. Now we start with a typical cost frontier function to estimate banking efficiency, where a bank I is observed over a time period t and is considered to produce a vector of outputs given a vector of input prices with a specific technology and incurring a specific cost. Now, of particular importance are the two quantities, the NI-IT and the U-IT, which represent the NI-IT random noise and U-IT time-varying efficiency. Now, even though panel data do allow us to account for bank heterogeneity, this is left unexplored by initial efficiency models. A series of models by Kumbankar introduce a third term, the UI. This term is time invariant and captures the part of inefficiency that is not within the bank's ability to control directly, and this is called the persistent efficiency. So the paper by Green 2005 and the series of the Kumbankar papers discusses the debate between the persistent efficiency and the bank heterogeneity. Essentially, they argue about the same thing, but with an important difference. So if this third term is inefficiency, then it has to be positive. But if it is a random effect, as Green is arguing, then it can also be negative. Now, this debate is kind of solved with the four-component model that regards the persistent inefficiency to be different from bank heterogeneity. Now, the four-component model was introduced simultaneously by a number of papers by Colombi et al., Kumbankar et al., and Jonas and Kumbankar. And in this model, the NI is bank heterogeneity, the UI captures persistent efficiency, the NI-IT and the UIT both vary across time but also across banks and are random noise and residual efficiency respectively. Now, the persistent efficiency is associated with factors that are constant over short time spans, like, for example, structural inflexibility or regulatory environment. And those are factors that are not directly controlled by the bank. The residual component reflects managerial efficiency and can be adjusted over time as the bank removes some short-term rigidities. Now, in our paper, we estimate this model using the three-step procedure that is outlined in Kumbaka et al. 2015. And the overall cost efficiency score is the product of the persistent efficiency and the residual efficiency. We estimate a range of cost efficiency models, moving from a commonly used simple model, which is model M1 in our setting, to a progressively more complex model, which is model 4 in our setting. The input variables for all the models are the price of labor, which is defined as the salaries and employee benefits over the number of full-time equivalent employees. The price of capital, which is defined as expenses on premises and fixed assets over premises and fixed assets, and the number of funds, which is defined as total interest expenses over total deposits. Model number in model number 1, we're using a common frontier for both community and non-community banks, and the outputs include loans and securities. Now, model number 2 introduces a flexible technology where community and non-community banks have separate production functions that can accommodate differences in their business model. Model number 3 can be viewed as the 4-component extension of model number 2 that allows for persistent and residual efficiency decomposition. And finally, model number 4 uses a more extended output designation. Here we have the different types of loans as outputs. So we're considering loans to individuals, residential mortgages, commercial and industrial loans, agricultural loans, construction and development loans, and securities. To give you a snapshot of the efficiency profile of community banks, this graph shows the efficiency estimates for different groups under the 4 models that we have estimated. And we can see that the intersection group in most of the models exhibit higher cost efficiency. The inclusion and the compared to non-community banks, the inclusion and exclusion groups exhibit around 13% lower efficiency compared to the intersection group. And actually, the FDIC criteria seem to modify the community banking universe by including banks with higher cost efficiency. Our data, we're using quarterly data starting from 1984 up until 2019 that are extracted from caller reports. Information on the FDIC-identified banks and the community bank binary variable is extracted by the FDIC website. We have matched the caller reports data and the FDIC data using the FDIC certificate number, which uniquely identifies each bank in our sample. And we end up with an unbalanced panel dataset that consists of more than 20,000 banks and over 1 million bank quarter observations. This table here presents descriptive statistics for the cost, outputs, and inputs variables for the 2 groups, so for community and non-community banks. if we look at the input prices, we can spot differences in the choices of input mix between the two bank types. So the average price of labor takes the value of 26.26 for community banks and 25.97 for non-community banks. The average price of capital takes the value of 0.254 for community banks and the value of 0.375 for non-community banks. Now referring to the output quantities, the average values for securities, total loans, and for the different loan categories are all significantly higher for non-community banks. In this table here, we present summary statistics for the efficiency estimations for community and non-community banks from the 4 efficiency models that we are estimating. So the table presents overall efficiency scores and also the 2 decompositions under model M3 and model M4. Community banks show superior cost efficiency performance compared to non-community banks, and this result is consistent and significant across all model specifications. Model M1 reports the lowest difference in overall efficiency score between the 2 bank groups, whereas if we consider model M4, which is the more complex model, the difference becomes larger. Both models M3 and M4 suggest that community banks exhibit a superior residual efficiency performance. And both models show that community banks also outperform non-community banks in terms of persistent efficiency, which can be traced back to regulatory and business environment characteristics, like, for example, the favorable capital and accounting rules that community banks face. Now we look into the 2 components in more detail, starting with the residual efficiency. And the left graph shows average residential cost efficiency for the 2 bank type at state level, whereas the figure on the right shows the relative percentage log difference between the 2 bank group and its dispersion between the period of the study. We can see that community banks outperform non-community banks in terms of residual efficiency in all states, apart from Vermont. But on average, we do not observe significant cross-state heterogeneity in the community bank residual cost efficiency differential. So, as we can see from the figure on the right, in most states, community bank residual efficiency premium is below 5%. Now, if we turn to persistent efficiency, we see a different picture. So differences in persistent efficiency are more pronounced across all states, and we can see that community banks have a substantial lead here. As we can see from the graph on the right, the important cross-state heterogeneity in persistent efficiency differential is between -5% in Nevada to 40% in Delaware. So it looks like some states actually offer a better environment for community banks to do business there. So there are certain states that are more fertile, let's say, for the community banking industry. Now, in the next part of our analysis, we want to explore what are the drivers of cost efficiency for community and non-community banks. And of course, given the different nature of the two types of efficiency, we conduct a separate analysis for the residual efficiency and for persistent efficiency. So starting with the residual efficiency, as we saw, residual efficiency is time varying and bank specific, and we use we use a set of bank specific market structure and macroeconomic variables to explain the sources of residual efficiency. So the dependent variable is the residual efficiency score, which comes from model M4, and the independent variables are the community bank dummy, a vector of bank-specific independent variable, a vector of variables that capture market structure characteristics and macroeconomic environment, and also the interaction of the community bank dummy with bank-specific variables and the interaction of the community bank dummy with macroeconomic variables. Now we are using a different setting to explore the determinants of persistent efficiency, because persistent efficiency is constant over time at bank level. And for this reason, we're using a state level analysis, where here the independent variable include bank-specific information, macroeconomic market structure and business environment characteristics, and also financial development indicators. And the dependent and bank-specific variables are expressed as a relative percentage log difference between the two bank types at state level. So it is calculated as the log of the variable for the community bank over the log of the variable for the non-community bank multiplied by 100. Now, what are the results that we get from our analysis? So starting with the results on the residual efficiency performance, here we are presenting the results from model M4, and models 1 to model 8 present different specifications of the basic model, so with a different mix of bank-specific and macroeconomic variables. If we, the main focus here is the community bank dummy variable, and the results from all models suggest that community banks actually exhibit a higher residual cost efficiency than non-community bank. Now, the coefficient on total assets is significantly negative, and this suggests that large banks exhibit lower residual cost efficiency, probably due to these economies of scale. If we look at the interaction of size with the community bank dummy, we will see that the sign suggests that the negative effect of size is actually more pronounced for community banks. So it appears that the small bank size is actually an important factor, a catalytic factor for community banks in order to maintain their efficiency advantage. A higher core deposit to assets ratio is negatively associated with residual cost efficiency, suggesting that banks that fund their assets primarily via deposits tend to be less efficient. The interaction between the community bank dummy and core deposit ratio has a negative coefficient, which suggests that the effect is more pronounced for community banks. Actually, community banks are subject to little competition when it comes to deposit taking from the local clients. So community banks may do not have to work as hard to attract deposits simply because they are the only banking option in their area. Also, the percentage of residential mortgages to total loans has an interesting reading. Since residential mortgages appear to be associated with a higher residual efficiency, this makes them an attractive product for the banks, especially given the fact that they're kind of homogeneous as a product, so they can easily be scaled up. And this relationship can partially explain why this product is particularly attractive among online lenders. And this table here presents the results from the persistent efficiency performance. Now, at the state level, community banks achieve higher persistent efficiency when their financial stability differential to non-community banks is more pronounced, as we can see by the positive coefficient on financial stability. The positive core deposit ratio coefficient suggests that the key driver of persistent efficiency difference between the two bank types is the strategic choice of the bank to focus on traditional activities such as deposit taking. Now, the total assets enter the regression with a negative coefficient, showing that community banks' persistent efficiency differential decreases as they converge in size to non-community banks. So small community banks are most efficient when they are competing against a large non-community bank at state level. Income diversity has a significantly negative coefficient and indicates that when the community bank tries to diversify their income stream, actually they're losing out in terms of persistent efficiency. We also look at the effect that non-community bank concentration has on persistent efficiency. And we actually find that community bank persistent efficiency differential is not affected by non-community banks' concentration in the state. This finding could possibly underline the loyalty instilled to customers by community banks, who are actually unwilling to look elsewhere for credit and financial products in general. We have done quite a number of robustness tests. For example, we are aware of the fact that within the time period of our study, different supervisory regimes were in place. And for this reason, we repeat our analysis by splitting our sample in four distinct time periods based on different regulatory regimes. We also repeat our analysis using a balanced sample. We split FDIC-identified community banks on the basis of their assets into 5 different asset classes. To account for possible endogeneity between residual cost efficiency and bank risk, we employ an instrumental variable regression technique, and we instrument insolvency risk by using a loan loss allowance to total assets, return on equity, and equity scaled by total assets. Also, in our sample, we have community banks that have switched status. So it could be that one bank was a community bank up until a certain point in its life, and then maybe it got bigger and was a non-community bank afterwards. So we isolate the FDIC-identified community banks that actually never changed status across our full sample period. And lastly, we have also done a matching estimation. We're using a k-means nearest neighbor approach to estimate the conditional difference in residual cost efficiency between the 2 bank groups. To sum up, in this paper, we saw that community banks do business in ways that is quite different from non-community banks. Community banks that have been identified as such by the FDIC definition shows important reclassifications. Again, community banks that have been identified as community under traditional asset size definitions. In our study, we saw that these reclassified groups actually include financial institutions with a significantly different financial profile, and in such quantities that could affect a wide array of outcomes under examination. Next, we focus on cost efficiency, and we compare the performance of FDIC community banks against their non-community counterparts. And from our analysis, we find that community banks are actually almost 20% more efficient on average. We find that even though community banks perform better both in terms of residual efficiency and persistent efficiency, actually most of this efficiency premium stems from persistent efficiency. We also uncover substantial heterogeneity in the persistent efficiency differential of the 2 bank groups across different US states, suggesting that some states seem to be better suited for community banking. Our results also show that residential efficiency benefit, where banks benefit in terms of their residual efficiency by being more involved in residential mortgages. From a policy perspective, our results confirm that community banking performance is not uniform at state level. So the strategy of the regulatory authorities could incorporate measures that are directly aimed towards the areas that are in greater need. And we also believe that this is a study that could be expanded, given the fact that the FDIC definition is the basis for regulatory relief on this bank. We believe that it is important for future research to also look at different aspects of bank performance. One could be, for example, liquidity creation. So thank you so much for your attention. I'm happy to hear your thoughts and questions.
Thank you very much, Athina, for a very interesting presentation. Very strongly motivated right from the outset to explain why this is important study. A competent review of the literature that is, very exhaustive, especially in explaining community banks, but also in exploring, different approaches of measuring efficiency, from the straight efficiency ratio to econometric methods, and then going by default for the much more a plausible econometric test of stochastic frontier analysis. It's very interesting to see that in a number of states, federal states like Rhode Island and Maine, the community banks have a lion's share, a high percentage of the total banking assets. If here the report is that in Rhode Island you have community banks representing 92% of total banking assets, that's a very high number. And basically, one could argue that in terms of banking assets, it's the FDIC-identified community banks that matter. I think it's absolutely interesting in many aspects, including the aspects you have investigated, but also in many other aspects to see that the stability or fragility of banking in both states will very much be relying on the efficient operation of these community-based banks. Also exciting. I think there are quite many aspects of this study that colleagues may want to explore, also in terms of kind of implications. And also, of course, by definition, when we say FDIC identify the community banks, is that the Federal Depository Insurance Corporation has a very important role in making like a regulatory threshold of how these community banks are treated. So there are many aspects that for discussion here. I think the next approach is now to invite colleagues in the audience to give their feedback, questions, comments, interpretations, any type of feedback would be very much appreciated. So let me see a show of hand by a Professor Sorait Tumine from Makerere University Business School. Please, you have the floor.
All right, good, Joe. I hope we are all well. Can you hear me?
Yes, loud and clear. Very well.
Thank you so much, Professor Victor Murinde, for giving me this opportunity, and for Athina for the presentation, which to me is also very wonderful in terms of an insight in those community banks and how efficient they are. I have, however, a few things I want to highlight on and maybe take note of as you improve your work. One of them is when I read your slide number 36, where you were giving us some bit of the 5 classes of the community banks based on the total assets, which was a very good cluster. Yes, you can see we have these 5 classes. We have the one below 100 million, another one between. So those classes. Now, I think among the community banks you studied, there are several of them falling in those classes. Now, if that is true, I believe, for example, like a community bank falling under or below 100 million might be having benefits to employees that are different from those of a community bank that has total assets above 1 billion. So because of that kind of differences, I don't think I think it would be imperative for you perhaps to think about carrying out a further test to see if there exist significant differences amongst these community banks, especially based on total assets. Now, if there exist significant differences, then it will automatically shape these efficiencies of these community banks differently. For example, think about carrying out what we call a Turkey's post-hoc analysis. The Turkey's post-hoc analysis can give you a clear analysis of the significant differences amongst these community banks. And in that way, then we could have actually a discussion based on those three differences. Maybe there could be small community banks, maybe others could be medium community banks, others could be large community banks. And depending on those three differences, significant differences, now how is operation efficiency dealt with in those three key differences in that way? And lastly, I don't know whether from the community bank only the input costs are only three. For example, based on the labor, based on the capital, and based on funds. Couldn't there be other key input costs? Like where do you put the cost of technology, which is now actually becoming so much prevalent? Where do you put the cost of maybe we have these non-performing loans? Where can the non-performing loans be categorized? Because there could be some borrowers who default. And which category could, for example, those fall? Thank you so much. I stop at this point for now.
Oh, thanks so much. Your comments are very much appreciated, and thanks for exploring those 5 classes. In fact, there are many ways one could, extend this, but your comments are, very much helpful. And let me ask Athina and Vasileios, the co-author was also in the audience. Who wants to go first, Athina or Vasileios?
Can I go first?
All right, okay, go ahead.
Yes, so thank you so much, Professor, for your comments. They were both spot on. With regards to the first comment, you're right. So the reason behind doing this robustness test is actually the fact that there is not only significant differences among community and non-community banks, but there's also significant heterogeneity among community banks themselves. So, as you said, a community bank that has assets that are below 100 million looks very different from a community bank that has assets close to 10 billion. So the latter could be more similar to, let's say, a non-community bank. So yes, it absolutely makes sense to look for operational efficiency differences across different groups within the community banking universe. And with respect to with regards to your second point, so when it comes to the input variables, yes, we have assumed the same inputs for both community and non-community banks. Because after all, in our analysis, those two groups in our data and in the regressions that we're running, we're including all these banks. So we are using the same input mix for both. We tried to account, you mentioned technology, we tried to account for technology by using a different production frontier for community and non-community bank. That's why we have those different 4 models. But thank you so much for these comments. Vasileios, if you want to add something, please go ahead.
Yeah, we also assume that the cost function, the cost frontier can also be different across small community banks and large community banks as a further robustness check. So not only allowing different frontiers between community and non-community, but also within the community banks, the small and the large ones, we also allow different production technologies between them.
Thank you both Athina and Vasileios for responding to the important question from Professor Tumine. I think there are further suggestions from these comments, Professor Tumine, in terms of the fact that it's the regulator. It's like a central bank, identifying a community bank, so even identifying which microfinance organizations are going to play a role at the village level, at the community level. And I think that that's absolutely important because it's a safeguard for financial stability as well. So I think there are many things we can, get out of here of motivation for another study or other insights. Thanks indeed. So I can see another hand up from who came first? I think it's Hongbo and Jaideep. Hongbo is a professor of financial economics at SOAS, University of London. Hong, please go ahead and
thank you.
Share with us your comments. Yeah.
Thank you. I think you can hear me, right? Yeah.
Yes, I can.
And thanks, Athina, for a very clear presentation. And I found that this topic is very interesting. And also I found that the result actually is interesting in the sense that I'm still thinking about your result. So I have two comments probably. One is for your counterpart sample. Let's say community versus non-community. It is not so clear to me at this stage what those non-community banks are. Are they very big international banks, or do you also include, let's say, very small, even smaller than the community banks? For example, a platform. So do you include this type of lending facilities in your model? And that's something probably that's because of the background knowledge. And so that's the first one. And this issue matters because it matters who you are compared with. If you are compared with internationally reputable, very big multinational banks, then your results will be very puzzling. Actually, I'm thinking about that. Why? So why are they so good, yet they have been declining? And why we see so many international footprint of those very big banks? So who are they? So that's my first one. And secondly, I think it's very important that you need to be explicit about your theory. So what kind of theories that are underlying your empirical research? And therefore, you can use those theories. At least they should let people know what theory can predict the result that you have obtained, and you are trying to convince people. At this stage, I'm sorry, I feel I'm flying somewhere. I'm not grounded by theory. So maybe that's my second comment. Thank you.
Thank you, Hong. Let's go back to Athina or Vasileios on those two points in the comments.
Should I go first?
Yeah, go ahead, please.
Yes, thank you, Hong, for both of your comments. Now, on your first comment that refers to non-community banks. So in our sample, we have basically all banks in the United States. So yes, it includes banks that are very different, some of the banks that are very different from one another. Now, the the criteria that are imposed upon community banks have certain limits on their asset size and also on business model criteria, which differentiates them from the non-community banks. But I think that what we could do is maybe provide a few more descriptive statistics on community and non-community banks. Actually, in the paper, we do have a table with that. So key financial ratios for the two bank types. I didn't include it in the presentation because it was already very long. Maybe in the future, it is something that should be included also in the presentation. With regards to your second comment, I need to think about it a little bit more on the theory. And we don't have, currently in the paper, we don't have a hypothesis development section, but maybe this is something that we should include. But thank you very much.
Yeah, thanks very much, Athina. I think also those constructive comments from Hong. Yeah, it's very much true.
I could also add a few points.
Yeah, sure. Yeah.
On the first one, so
go ahead, yeah.
On the basis of the FDIC, of the new FDIC definition, any bank that is registered and regulated as a bank, that means any financial institution that needs to fill in call reports. So that would obviously exclude any other finance company or anything like that. So any bank that has branches in more than, if I remember correctly, more than 3 states, okay, that automatically would be classified as non-community bank. Obviously, a bank that is very large in size, that's another classification, and a bank that specializes particularly in securities. So that would imply that the loan to assets is very low for that bank. So we have size criteria, we have financial criteria, and we have also geographical criteria. And also bear in mind that the US, because of regulation structure in the past century or so, they are home currently to almost 5,000 or 6,000 banks. So it's completely different than the UK or Europe. So you may have banks in states that you have not seen before. Very local banks with only a few branches in a few counties. So that's typical of the US banking system. Of course, you would have the mega banks like Bank of America. Theory, yes, as Athina said, we don't have a theory. Of course, we try to address the the closest thing we have to the theory is the relationship banking approach, which we can structure a little bit better. And of course, we seek to address this novel definition. So we add to the comparison of this definition. Before the definition, a community bank was, as Athina mentioned, simply on the basis of size. And besides that, the only difference it made is just for us, the academics, so that we would basically compare small banks with large banks. But now it makes a difference on how the regulator treats these banks. So it becomes much more important now. So yeah, we could add probably something there. Okay.
Yeah. Thanks to both you, Athina, and Vasileios for those responses. Already this morning at 9 during the reading group, we're looking at this paper, based purely on US banks from the exclusive bank data on US banks. And just to realize that basically what Vasileios is saying is very much true, that there are so many, banking units, and so you have many banking units. You have those that now are FDIC identified community banks, and then you have, in the US, you have bank holding companies. If you want to look at the behavior of those bank holding companies. So yes, all these matter, and I think it is to show that the behavior we're investigating now is only unique to FDIC-identified community banks as special banks for community transactions. On the theory, I think, it's okay. I think it would have to be built by, hypothesis setting or development of, there are two things that testing. One is actually, measuring the efficiency, which, could be measured by many ways, but in this case, the stochastic differential analysis brings in a new dimension of, the residual component that you are trying to tie down. And second, there is the second part of the regulation, I think, is trying to explain what accounts for differences in these things. So I suppose this is where the hypothesis for guiding the investigation would be, helpful. But it's part of ongoing work. Yes, Jaideep. Jaideep is a senior colleague in the Center for Global Finance at SOAS. Jaideep, please go ahead.
Thanks, Victor. Hi, Vasily. Hi, Athina. Thanks for the presentation, Athina. So I just it's really interesting. But again, I think I'm going to follow on from the previous two sets of questions, and it looks like it's the same sort of thing in my mind from the beginning. Is like trying to square the circle. So you've got these banks which are really efficient, which are smaller, and so. Is that meant to be the takeaway? Like the small banks are more efficient, so then are they more profitable, or is there sort of a link between efficiency and profitability that needs to be sort of understood, or is it so? Or is if small banks are more profitable as well, then there is something even more complicated going on that is difficult to understand, or there could be something to do with the efficiency measure, right? So like the way the costs are determined, like that was also raised before. And so the point being that if if having fewer offices or something, or the being in a rural area where the cost of your land is very little, or your branches is really small, if that's what determines efficiency, right? I mean, you having an office on Madison Avenue is very different, right? So, and then again, of course, you're going to give mortgages on higher value land and so on. So that trade-off is kind of a bit confusing to me. So if you think about efficiency versus profitability in this context, and then the other thing I was kind of wondering to what extent the mechanical element comes in from the time variation in the deposit ratio. So you see that the deposits kind of like the gap between the deposits and the loans deposit levels of the community and non-community banks, it kind of shrinks over time, but it's not a secular trend. I think it's related to interest rates, but I could be wrong. And if that is the case, then what does that have to do with how your efficiency measures work out? Because again, we were talking about this morning as well. The banks make a lot of money from fees. So is it the case of like the number of accounts that they charge fees from was the number of small deposits, let's say, that generate their sort of efficiency, or is it something else? What I'm trying to figure out is the mechanics of where this sort of pretty significant result is coming from. You have a statistically significant improvement in efficiency if you restrict one group of banks, and the smaller you make them, the more efficient they are. So then, is it the measurement, or is it something else? That's what I'm trying to figure out.
Thank you.
I mean, that's my question really. So I mean, it's not a question; it's more like a kind of a reflection. But I can't. If there is a question in there, I hope you found it. So I mean,
I think if I can respond to some of these, Obviously, there is a relation between the size in like banks and the efficiency. So that's not really against the literature. Like smaller banks, sometimes they are more efficient. The novelty here is that, so if you have a definition that also adds other characteristics, so not only the size, and we saw that in the paper. So there is something extra. There is an efficiency gain for these banks simply because the way they do business and the way the FDIC identifies them too is different. So they have a size premium, definitely, because many of them are small, but there is also a premium based on the different business model. So that's on the comment on the efficiency and size.
Yeah.
Profitability. So it's not something we typically look at, because efficiency is supposed to be linked with profitability. I mean, you are producing more output, so you should be theoretically more profitable, but that's not something that there's consensus in the literature. Now, what we show is that actually the excluded community banks from the FDIC definition, they tend to be a little bit more profitable. So sometimes, and this also echoes in other alternative banking models. So profit maximization is not the ultimate goal, specifically for these very local banks. So they may have other priorities, perhaps serving the local community, or perhaps investing investing some money for the local good, or something like that. So strictly judging all these banks with a simple ROE measure, I don't think it does justice, because they simply may have different goals. That's why we don't do profit efficiency. We typically do costs. So it's more acceptable to kind of minimize costs rather than maximize profits. I mean, at least in the theory. The deposit ratio, I really have to see the graph again, but maybe there is something worth looking at.
If you're looking for the graph, it's around like slide 10 or something, I think.
Yeah.
Really far back.
Yeah, at the beginning. Yeah, sorry. Yeah, I think that's the one that you're referring to, the dip, right?
Yeah.
Yes.
So the
you
core
can see here,
deposits
there's a
to
kind
assets.
of a trend. Yeah, I mean, it's like it's a very different, and the gap is kind of very specifically changing over time. And yeah, so just kind of curious what's going on here. Like, maybe that's got something to do with the
gap between the core deposits to assets. You mean the red one?
So the red and the blue.
Okay.
So if you think of that, so supposing if the basic logic here is that, I'm trying to get at the mechanics, right? So if the basic logic is that the loans are given at variable rates, and deposits fall in value when interest rates fall, for example, or something else happens, you're in a recession, for example. This was 2008 is the global financial crisis, and the loans are in variable rates. Then you won't have an impact on the loans, but your other assets have fallen. So your loan to assets ratio does not really reflect sort of an increase, sort of a real increase in loans as such. So this might be related to the basic difference in the stability of the deposits and the loans. And so that's what I was trying to figure out. Because if the loans are constant, then you would have a ratio, something looking like this. If they're at variable rates, right? So I mean, in terms of because the remaining assets would have fallen in the financial crisis. So so that's what I'm trying to figure out, like whether that's sort of driving it in a sense, whether the time variation has got something to do with it.
So whether the different valuation of the loans during crisis.
Yeah. So I mean, for example, because someone was talking about not including non-performing loans and so on. So if there's, especially if they have some kind of an advantage in terms of the regulatory restrictions on how to classify loans and stuff like that, then it becomes even more likely that their loans will not fall in value when their other assets are falling in value.
No, if community banks have non-performing loans, then the accounting criteria are the same as normal banks.
Okay.
So yeah, if a loan is 90 days past due, it's classified as a non-performing, irrespective of whether the bank is community or non-community. The difference would be that the community banks are less likely to have non-performing loans,
So then that's your story,
because of
right?
the different screening mechanisms they have. Yeah, that's the main story. So that's the intuition behind this relationship approach that they typically do.
Yeah. So
And
I mean, this shows that. Yeah.
We see that in these asset quality indicators, that the asset quality is higher in the community banks. The asset quality of the loans, of course, the asset quality of the securities is the same. So that is loans, that is not non-performing loans, obviously, on the graph. So non-performing loans to loans for the two bank types might show what you are suggesting.
Or in fact, this as well shows that because it seems that if your loans don't fall because you've got much better performance on your loans, that's basically the differentiator, and that was your relationship banking theory to begin with. So that seems to be the thing to emphasize from the start, right?
I think what ZIDP is saying also refers to the part of literature that has shown that actually when the client and the bank have developed a more personal relationship, then it is more likely for the bank to extend credit to this customer, even though this customer might not be paying, let's say, at the beginning. And this actually gives the opportunity for the customer to perform better in the future and actually pay back the bank. So an indication of relationship lenders performing better in terms of non-performing loans. Maybe this is something that we could include here.
Yeah, explain. Yeah.
Thanks. So I mean, I'm not going to take up more of your time, but I think that basically it's now giving me a bit more of a sense of like what's driving the differences and what you're looking for, right? So I mean, like basically, you said you started with relationship banking, and it seems to me that needs to be like emphasized more. Even Hong's comment was about theory, right? Mm-hmm. So the theory being something like that, some differentiator, right?
Okay. Yeah. The discussion touched somehow a discussion just ongoing touched somehow on the issue of profitability. But I think perhaps that's an extension of the paper, another paper, because of the ongoing debates between efficiency and profitability. It would normally be expected that highly efficient banks are not also highly profitable. But we have seen the coexistence of high efficiency and high profitability, say, among UK banks. And that's mainly because the profitability is coming from, off-balance sheet activities, the kind of fees that JDP was mentioning, while the efficiency is on the on-balance sheet activities, basically deposits and loans. But I guess this is an extension of this paper, which would lead to another debate. At the moment, I think the focus on efficiency is sufficing. And now, just as I was about to close the questions, I see Moses Tefula spent most of his other days estimating these stochastic frontier models for many banks. And I don't know if he has an insight. There were 4 models. Is there missing model number 5 that Moses wanted to put on the table? Or, Is he converted completely by this? Yeah.
No, thank you, Professor. I will not give any specific comment now, but I found this the most interesting paper in terms of my interest in the area of research. I was trying to make a comparison when the issue of community banks came up. How would we look at community banks in other parts of the world?
Oh, yes.
We have those circles, others call them cooperatives. We have the small cooperative credit schemes in parts of the world. And I was trying to see the similarities of these community banks. And I used to be a credit analyst for quite some time, and I could see how the models that we use in analyzing credit worthiness would vary greatly when you are looking at community banks, as you call them. But I'm sure in our local other environments, we have circles and so on. So this is a paper, and I would be very interested in following up this area of investigation, because it is one of the areas I've been, as Professor Murinde said, I was for over 20 years in banking, small credit, small farmer credit, and later bigger credit. Now I'm trying to get into climate finance. So thank you for this very interesting paper. I'm sure we are going to get in contact, and I'll be taking more interest. This is very, very stimulating. Thank you very much.
Excellent. So this paper is very well resonating with the policy and practice. Thank you very much. That's much welcome. Okay. I can see the discussion in the chat, actually represent a continuation of the issues, and the colleagues that have posted the comments in the chat, thank you very much. Includes Jaideep, Hong, and myself, and these are some of the discussion that we've been involved. So I suppose if there is no hand up, I can't see any hand. Let me check on my counter just in case. Yeah. I see quite a number of people here, basically, who are researching mainstream banking issues that relate to this paper. There's something very specific about this work, because in most of the studies on US banks, including the papers that we've been looking at in the reading group, including this morning, you are looking at these big mega banks. You are looking at the bank holding companies. But you see, these are not only community banks, they are FDIC-identified community banks. They have special interests. The FDIC as a unit has interest in these banks, okay? And, therefore, I think this paper will go, miles and miles. It will go very far. It will also have great implications for policy and practice, and maybe also will have a great research impact. I think I'll bring you back, Professor Tumwine, because maybe we'll have something called BOU, identified community banks in that neck of the woods. Yes, Professor.
Okay, thank you so much, Professor, for that, for allowing me to come back again. I want to, as what you have just mentioned, the paper can go miles and miles.
Yeah.
But since this paper is a brain of both academia and a practitioner, a practitioner might not be interested in a theory, but an academia would be interested in maybe a theory that guides the study and perhaps a theoretical contribution. So in this case of operation of efficiency, which theory or model is he using? It could be maybe the Koba and Douglas production frontier. I don't know, but at least in this case, we did have one, and we see how they build on that theory and make a very big contribution. But again, lastly, this question of size significance differences remains a key issue. And in order for this work to be very, very good and pronounced, the authors need to look at that the community banks size and how that size affects their performance, their efficiency, is to me very, very pertinent. Thank you so much.
Yeah, thank you, Prof. Tumine. As you can see, the co-authors, there are 5 co-authors, and including some very well-known policy practitioners, and of course, a number of academics. But let me ask Athina or Vasileios to respond that on the theory, especially when you mention the production functions. Typically, some of the work here borrows from translog production function that is converted by Shepard's lemma into cost functions, or it even could be Gounopoulos, straight. So, okay. Do you want Vasileios to give a highlight, quick response in the interest of time?
Yeah, we use the translog. I'm not sure if that answers the question, if there was any other aspect. Like we use a translog with several assumptions on the model. So we basically start from a very simplistic, the most simplistic stochastic frontier model, and we extend all the way to the 4-component one, as Athina has mentioned. Of course, with time effects and changing production functions.
Yeah, the translog is very versatile because it does allow for substitution between various inputs and outputs, and the full range of the products that you had mentioned here, much more versatile than a single Gounopoulos glass here. Okay, Athina, you
I just want to say that the issue of theory underlying these results is a point that a few colleagues made during this seminar. So this is something that probably we should think about a bit more, because we are also mentioning the relationship banking approach and the theory behind that. So maybe we could also link our results to this literature.
Yeah, absolutely. Yeah. The literature, and then you have hypothesis development and tractable theory that helps also in the interpretation of results. So many interesting results, and it would be great that all results are tying in together. Yeah. Jeffrey, yes. Jeffrey, this is our emerging scholar in banking. Jeffrey, I could see your comments, but I'll give you an opportunity. Although we have only about 5 minutes, I'll give you an opportunity to give your parting shots.
Yes, hello, and thank you, Athina, for the paper. I was just wondering whether there's a role for guarantee system, especially for when you were talking about the profitability and efficiency, especially where the high level of efficiency is coming from. Because there was one paper I was reading one time where especially for these small banks, the role of guarantee system. So I don't know if you've explored that area. I just wanted to see that. Thank you.
Thank you, Jeffrey. So in short, we have not explicitly looked at the role of guarantees in efficiency. Maybe this is something that we could include possibly in our second stage regression. Yes, thank you. We could look into it.
Thank you indeed. We are running short of time. So I will thank all the participants. And when I look at the participants, I can see quite a list of people who work in banks in general. Both the I can also see policy makers from central banks, and that's and practitioners. That's very helpful. See, of course, a lot of academics. So it's good that you are able to make the time and contribute to this discussion. And Athina and Vasileios have also availed a link at the paper where you may be able to look at the current version of the paper. But of course, it's ongoing. It will be updated as we go, but you still have a chance of making further comments and participating in the development of this work. But finally, I want to thank the co-authors and presenters, co-presenters, Athina for very, very clear and interesting presentation, and you, Vasileios, once again for very interesting discussion and giving in further clarification, further justification, and also encouragement of appreciation of the discussion. So thank you all. We're running out of time, but we'll continue the discussion, of course, offline, and we'll see you again here next week when we have an exciting presentation relating to finance, the quantitative easing of fear during rare disasters, like the multiple disasters of COVID and others, energy and one others. So this will be a finance in a very novel environment, and I look forward to seeing you again here, next week, same time, same place. Thank you very much, and goodbye for now.
Thank you for your comments.